Honest with you, it is enormously frustrating because, and I think the evidence that we've had subsequent to the conflict breaking out bears this out. I was expecting that I would be able to be here this afternoon and we would be at the inflation target, and I think the evidence bears out that we would have been. We're not, and I think the overshoot is pretty much entirely due to events in the Gulf. And I'm afraid, it is most likely that there will be some more to come because the UK has there is naturally a delayed pass-through, and then the energy price cap tends to, in the UK relative to some other countries, tends to sort of, in a sense, also cause some delay to the pass-through. So, that's the world we're in. It is highly, of course, uncertain. Indeed, I would go further than that and say it's highly unpredictable, actually, as to where this is going to go. Three things are really important in terms of, I think, thinking through that situation. One is, how long is this conflict going to go on for? Two, how much damage has been done to the energy infrastructure, supply infrastructure, and how long will that damage take to replace even once the conflict comes to an end? And then the third one, which is the one that obviously we are most focused on in terms of what we can do with monetary policy, is what are the likely second round effects from that? And we may come back to say it, but we are in what I would call a trade-off position, which, as I say, is we've got inflation going to be higher than we expected it to be, activity lower. Nearly all our simulations suggest slower growth rather than a recession, but again, I caveat that with the highly unpredictable and uncertain point. And we are having to make judgments about not only the scale and duration of the inflation, but also this key question: what is the context of the economy in which it's hitting, and the degree of softness we're seeing in the economy? So that's the short run. The long run, I think, is in some ways, if you're looking at the overall economic situation, even more important, actually, and it's this. And the UK is not unusual in this respect, so I'm not telling you a sort of particularly UK-specific story, but it's highly relevant. We've had slower growth in the UK now really for the last sort of 15 to 17 years. And if you talk about potential growth now to start with, the sort of supply side, that really shows up in lower productivity growth rather than lower labour supply growth. It's really a productivity story. Now, that makes a very big difference. I mean, we've done some sort of very naive calculations and sort of said, well, imagine you had the same, you'd had the roughly sort of 2.5% potential growth that we had pre that period. So for the sort of period before that had continued. Imagine we had exactly the same shocks. So we had COVID, we had Ukraine, we had this one. Imagine we had exactly the same fiscal policy. Where would we be today relative to where we are today? And the answer is, I think we would be in a very different debate about policy, particularly fiscal policy, but it affects monetary policy as well, because obviously it's a speed limit for us. So this growth story is really very important. As I say, now it's not unique. The UK is in a similar situation to many countries in this respect. But I think it begs a lot of questions around two things which I think are important drivers of growth in the longer run. One is trade, the openness of the economy. The other is technology, because I think ultimately technology is the ultimate driver of growth in the long run. And it is quite possible that, and we've seen this before in British history, that we've been between periods of what we tend to call general purpose technology and innovation. So we had that period I was talking about in the past was the sort of ICT internet period. The question is, what's going to be the next one? We may come on to this later. Most likely it's AI and robotics. But that's this question about the rate of growth in the economy and the impact of that, to my mind, is critical.
Very interesting, thank you. Well, there's lots there we'll come back to, but let me hand over to Lord Burns for the next question.
You've just mentioned the issue about the second round effects of an increase in oil prices. In the past, I would say that the second round effects have generally been substantial and often underestimated, and that's been particularly the case when the economy has been running hot.
Yes.
Had an expansion of demand and also monetary growth. And the key policy judgment that you set out in your monthly report is that you think that the present conditions with weak demand and a weak labour market may possibly lead to the second round effects being smaller than has been the case in the past, although if it's stretched out, I think your report goes on to say they could even be that much higher.
Yes.
Some commentators, I notice, are worried that the consequences of this approach is likely that policy tightening will be too late, again, as there's often been in the past, as one waits to see the evidence unfold, and by the time the evidence unfolds, it's a bit too late.
Yes.
Does this worry you at all?
Yeah, so you're right, I agree with you. You can't wait for the hard evidence of second round effects to be with you, because it will be too late at that point if they are larger. So it is going to have to be a judgment. It always has to be a judgment. I would say two things about the current situation. One is, going into this, we were seeing softening in the labour market. We were seeing something of an output gap opening up, we thought. Softening in the labour market we saw in, for instance, the behaviour of vacancies. We saw it in private sector wage settlements converging back down to a point where it looks reasonably consistent with the inflation target. Latest numbers do. I do make the point about private sector advisedly. That was very deliberate to say that, because there is a gap. And there is a widening gap, if anything, between the private sector and the public sector. But the private sector settlements, which we tend to look at more because they obviously feed directly through into pricing, or more directly through into pricing. So there is that body of evidence. And certainly when we go around the country, when I go around the country, and this was in commentary on things that happened last year, such as the national insurance change, firms saying that they were having to take more of it on their margins rather than on prices. Now, the second thing I would say on this is that a little bit depends on where you start, and different members of the MPC will have different views on this, but in my view, we have already tightened, for the reason that we were expected to cut rates this year, pre the conflict. And I think that was reasonable. I was thinking perhaps one or two cuts this year, and the market was pricing one or two cuts in. That's off the table as a result of the consequence of the inflation consequence of the outbreak of the crisis, of the conflict, sorry. And the most obvious illustration of this is mortgage rates. So the 2 and 5 year mortgage rates are up pretty much 1%. So there has been a tightening of financial conditions. So I'd put those two things together to sort of, in a sense, I hope help with answering your question, which is, I fully agree with you. You can't wait for the second round effects. I think there is evidence of softening, but I do think we actually have a bit of time, not least because we have in effect tightened policy.
The report also, you set out, but where the risks lie of doing too little and too much, and people are very interested in this question about the degree of flexibility that's built into the current remit. And
yes.
a sort of broad question. I mean, do you think the amount of flexibility that you have within the remit is just right for the kinds of circumstances that we face? The extent to which the judgment about how rapidly one seeks to bring the inflation rate back down to target when we're above.
Well, I think it is important to have that flexibility. Now, it's quite interesting. I made some remarks on this in a speech in Reykjavik last Friday. There are sort of two, oversimplifying a bit, there are two forms of remit that exist in this world. One is what tends to be called the dual mandate, the sort of thing the Federal Reserve has, where there's a price stability part to it and there's an employment part to it, and they sit on the same level. They're not weighted explicitly. That's a matter of judgment, and we of course only have the former at the sort of the top level. But then, as you rightly say, we have this language about so what we tend to call the trade-off language, which is, as you said, the speed at which we can bring inflation back to target when we face the sort of situation we face today. I think, maybe because I'm more used to it, but I think our version has merit. I think it isn't, of course, completely prescriptive. It leaves judgment. But I think it creates more of a framework for the decision-making than the dual mandate structure, which I just do think leaves it very open what the weights are on those two things. So I think it has the benefit of causing us to need to be much more, in a sense, considered and explicit in terms of saying how we're actually using that language and how we're using that part of the remit. And this is clearly a moment to do so. So at the moment, I would say, if it is the case that the second round effects are going to be muted, then this part of the remit will be critical to the response.
And a final question. You worry that, I was looking at the three forecasts that you make, and it seemed to me, the three circumstances set out. The end result of this is going to be that for almost the whole of the 2020s, we're going to have had an inflation rate above 2%.
I'm trying not to take this personally.
I'm not, it's not at all personal, but do you think that this in any way, and in fact for really quite a large part of the time, we turned out to have been above 3%. Does this throw any doubts on this set of arrangements that we have?
Well, I'll take that in two parts, I think. What it does illustrate is that we had a period, obviously, from the very early days of this regime in the pre-financial crisis period, which was a period of very good conditions, the nice period, as Mervyn King called it. And it hasn't been like that recently, indeed arguably since the financial crisis, but certainly recently we've had a whole series of shocks, some of them global, one or two of them not. And they've been mostly negative supply shocks, which have pushed inflation up, which are the harder ones to deal with, obviously, in a monetary policy framework. Now, first of all, I think, general answer to your question is that any framework has to deal with the more difficult conditions. If it can't, it's no good if it can deal with times when life's easy, but it can't deal with the harder conditions. So that has to be true. I don't think it's an argument for saying if you just raise the inflation target to 3%, everything would be okay. I don't think that's the answer to that question. I think that would be too simple an answer, a simplistic answer to it. But I think it does come back to this question that it puts us in the position where we have to focus more on how we manage the path back to target. And of course, ultimately get there, because we've got to give the public confidence that the target is for real.
Thank you. Baroness Wheatcroft.
Thank you. You talked about the fact you're already effectively tightening by not bringing down rates. And mortgages have responded, and property prices have to a certain extent.
Yes.
But other asset prices really have not come down very much at all. And I just wonder whether you were surprised, I don't suppose you were, by the remarks of the Deputy Governor last month, in April, when she was really quite outspoken about concerns over asset prices.
Well, I wasn't surprised at all.
Would have been a surprise.
Yes, not at all. Let me say, let me start. There are really two stories going on in the world economy at the moment. So we've talked about obviously the impact of the conflict in the Gulf, the effect on energy prices. So that is the first story. The second story is the AI tech story. Much bigger story in the US, but it's having sort of, again, repercussions for the rest of us.
And our institutions are investing in these things.
Yeah. And this, I think, is the way to square what otherwise appears to be the paradox that we're seeing in financial markets, because what we're seeing is that if you look across the major markets, take it in three parts, the impact of the Gulf and the energy shock is almost entirely focused on particularly debt markets and particularly government bond markets and yields. exchange rates actually relatively little affected. Now that is not illogical if this is a global shock. And then the third one is sort of risk markets, so equity markets and credit spreads, which if you spent your life only looking at those, you would not realise there was any event going on in the Gulf. I think, as I say, the way to square those two, because otherwise you think this is very strange, is you've got these two big developments going on. So Sarah's comments were really addressing the question of asset values in equity markets and credit spreads, and saying, what are the risks around those, and how worried should we be that they seem to be, in a sense, ignoring everything else that's going on around them? And there are risks there. I think you may say it was a set of risks from the Gulf, because this thing could become big enough to, in a sense, dominate the AI type story. I think the second thing is that there are. I'm actually quite a believer in the AI story as an economics proposition, so I'm not saying this to sort of undermine AI. I think it is actually very important. But obviously the job of equity markets, for instance, is to value the future stream of earnings, so to value the future productivity gains from this thing. And they could get it wrong in a number of ways. So they could get it wrong in, think of three ways. One, obviously they could just overvalue the whole thing. We could still have a very positive benefit from AI, but they could get it wrong in terms of the degree. Two, everybody is currently priced to be a winner, in the sense of and you look back at history, actually everybody usually isn't a winner, actually. That's a fairly unusual state of affairs.
So are you predicting the equivalent of the dot-com crash?
I'm not. No, it's not. It's not quite that, because in the dot-com bubble you had people with no earnings and no prospect of earnings. I'm making a slightly more modest point that if you look at something like the internet, for instance, you look back at who the original sort of big pioneering names in the internet were. They're not necessarily the ones who are here today. So pricing everybody today to be a long-run winner isn't really consistent with history. The third one, which I think is important, is that, again, I'm drawing on history. These, going back to what I was saying earlier about technology, these are what I call general purpose technology innovations. So things like electricity, internet, tend to take longer to come through into the productivity and economic growth stories than people predict. So there's a famous comment by Bob Solow that you can see the computer everywhere except in the productivity series. There's a famous story that, from Edison first doing a power station to US productivity was about 50 years. It was 8 decades between James Watt inventing a steam engine and it coming through in what we think was UK productivity. And that's because it usually involves a lot of other innovations to sort of go with the initial thing. Now, I think AI will be a lot quicker. The world's moving a lot faster than that, as we're seeing with AI at the moment. But it could well be that the markets are too optimistic about that speed of pass-through.
Is it factoring in sufficiently the scale of the investment that companies like Anthropic or even
it's huge.
SpaceX?
Yeah. Yes. It does require very substantial, and that is taking place, very, very substantial scale investment. So just to put that back into context to what Sarah said, there are substantial risks there. Yeah.
And a final quick one. Is enough being done to regulate the alternative loan markets?
Well, first of all, that private credit or alternative loan market, of course, is supporting a lot of the investment in the tech sector, and that's a good thing, by the way. It's a good thing. I also think, there is quite a lively debate, obviously, as to whether we've got this because we've over-regulated the banking system. My response to that is, in good part, the difference, we want these two things to coexist because the liabilities of banks are money, people's deposits, and people want assured nominal value for their money, for our deposits. But you also need an investment sector which doesn't have assured value, which makes money, but may occasionally lose money, where risk is taken. And we want these two things, and we don't want them regulated in the same way, in that sense. Now, what, however, is the worry in the private asset world? Well, I would say generically two things. One, do we fully understand the linkages between the two? So they're not living on separate islands, they are connected. And that's why we're doing in our second system-wide exploratory scenario to understand the interconnections. And the second thing is, do the investors, and particularly now it's going into retail investment, understand what they've got? Because if they do, then the odds of it being a sort of smooth transition and the bumps will be sort of smoothed over much higher. If they don't, then it will be, you know.
Do you think?
I think the jury's out on that one, frankly, at the moment. I mean, I'll give you an example just briefly from this country. So you may remember some years ago we had the so-called property funds. And that blew up. Well, it certainly blew up after the Brexit referendum. And these things were, I mean, weirdly structured in the sense that they were what's called daily dealing in an asset that not only you couldn't deal daily, you couldn't value it daily because it's commercial property. And the sort of the escape clause was to suspend the fund, suspend redemptions, which we did. Now, in the end, it sort of passed off. And I ended up concluding that I think probably most of the investors, even though what was on the can looked weird, it was completely weird and, you know, nonsensical, I think they probably knew what they'd got.
Maybe.
But you can't tell that in advance that well.
Thank you.
Thank you very much. We're moving on to energy now with Lord Pettiger.
Yes. Sorry to leave this fascinating subject, Governor. Let's go back to energy. So if Hormuz carries on, if the energy crisis or the energy costs were to rise more, and if the government was tempted to put in a package not dissimilar or some form of support package as we saw in Ukraine in the first round in 2022 and 2023, in your mind, what would be the most desirable way from a monetary standpoint for the government to structure that? And I should say the context against this is that in 22-23, the package costs about 2% of GDP, called it 55 billion. And secondly, there's been a lot of admonitions or some form of statement from the IMF suggesting the government should resist any kind of support given the state of our, the cost of capital already in the economy and the level at which the gilts are trading. So that's the overall.
Well, look, it's not for us to sort of, advocate fiscal policy. So let me sort of be quite careful what I say. First of all, I would say this is, so far at least, this is nowhere near as big an energy shock as the 2022. And 2022, of course, had two legs to it. So, I mean, the energy prices went up, you'll remember, when the conflict broke out in February, and then another big leg up in the summer of 2022. I think I would limit myself to, in a sense, I'd put a little bit of a sort of frame on what the IMF said, was that I think they were really supporting the sort of the phrase sort of temporary and targeted as a set of measures. So in other words, they were steering against a sort of a big all-embrace. If you're thinking about it, be careful about big all-embracing packages. Do something that's temporary and targeted in the sense of the recipients, obviously, temporary in the sense of the length of it. And I think in the context of overall fiscal policy and the overall fiscal position, I think that is sensible advice.
When you look at I was looking at the notes here, and I hadn't realized that because of the energy cap, the level at which actually prices are due to rise, even if nothing happened in Hormuz, even if we had some more resolution, nonetheless they're going to be rising quite dramatically. Do you think that's in the price? Do you think that's in the market?
The July reset?
Yes.
Yes, I think it is, yes.
Okay.
Yeah. Because in a way you can work it out pretty exactly, because the so-called observation window is over now. So
we know what the price is.
I mean, our staff always do it in advance, and they get it pretty close, actually, and I know outsiders do as well. So once you've got through the observation window, you can get it pretty accurately.
Thank you very much. Lord Young.
In the May's lecture, the Chancellor promised a roadmap for future fiscal devolution, and she went on to say that this would be a permanent transfer of power and resources from central government to local government. Are there any implications for monetary policy if you have a country with increased regional fiscal autonomy?
Well, so our convention is that we take the government's fiscal policy as announced and use that to form our views of the future impact on the economy and therefore for monetary policy, and we use that in our forecasting. So I think if as you said, if that were to come to pass, then we would do the same thing, but from the sort of the top-down perspective, we'd obviously have to do some more adding up because it would be a more devolved structure, but we would still do the same thing. I think we would add up the set of components of fiscal policy to get the overall position of fiscal policy. And we'd obviously then have to do the conditioning looking forwards on what the sort of stated policy was for each component of it. So make our life a bit more complicated, but I don't think it's undoable. Then I think we'd look at it on a second level, which is what I call sort of bottom up, if you like, and say, and here our regional agents would have a particular role to play. Is the consequence of that devolution of fiscal policy going to have impacts on the pattern of activity across the economy, which would be different to the one we're seeing at the moment? And I think we would do that as well.
Do you see any problems if, for example, a regional authority tried to develop a counter-cyclical monetary policy to deal with local unemployment? Would that pose any problems for monetary policy? Could you cope with that?
Sorry, we counter-cyclical fiscal policy?
Well, if they developed a counter-cyclical policy
yeah.
to borrow and inflate, to deal with local unemployment, does that have any implications at all?
Well, I suppose, first of all,
policy?
Two things. I mean, first of all, it would depend how substantial that would be. So it would depend on what sort of weight that would have in overall fiscal policy. Secondly, we would obviously, again, have to take it as what it is and then set monetary policy taking it into account. So, I mean, I'm sure you could construct sort of scenarios in which it could cause monetary policy to look different. I think that would be quite extreme as a sort of end of the distribution. I think most of the probable sets of what I would imagine regional fiscal policy to be wouldn't get into that territory, but it's possible. But say our framework is we can deal with. I mean, whether we like it or not, we could deal with it.
Thank you.
Thank you very much. Lord Razzle.
Thank you. We've had a number of witnesses over the months querying the quality of ONS statistics. Do you feel policymakers are flying blind, or has there been progress on data quality issues?
So we're not flying blind.
No, you're not, but other people may.
Well, no. So, and I'll come on to, I do think there's been progress. I mean, just go back, the sort of, obviously, the cause célèbre in this is the labour force survey, yes. Where that did cause us, and you know, it's on the record, I said it in Parliament a number of times, I mean, it did cause us problems, because it is very crucial to our work. Moreover, it coincided with a point in time where one of the most important elements of that was the so-called inactivity element of people who are not in the labour force. And whereas many other aspects of the labour force survey, so unemployment particularly, for instance, we can use other means of coming at assessing it. Inactivity, we are very dependent on the labour force survey for it's a particular sort of feature of that. So that was problematic, and our staff worked very hard to develop alternatives, which they did. I mean, the ONS have been working on the LFS now for some time. I think it's fair to say that the participation rate in the survey is now back to, I think, where it was pre-COVID. But there is still further work to do. They have put back the launch date for the transformed LFS. Certainly, we do have our chief economist, Hugh Pill, sits on the committee that acts as an advisory body for them. And I think Hugh's view was that was a sensible decision. He felt that they hadn't solved enough of the underlying issues to get to the point where you would be confident to launch it. So that work is still going on. It is a tough nut to crack. I think the ONS are doing the right things, and I do strongly. Obviously, we strongly encourage they keep going. I'll give you another example more recently, which I think is a very positive story. There have been question marks around the seasonality of the GDP numbers, and particularly first quarter, fourth quarter. And it appears that there has been some shift of the pattern of activity. It may be related to the going to one fiscal event a year. And there was an ONS blog publication a few weeks ago, which I thought was excellent, because it basically said, look, we've got it, we can observe it, here's what it is, it's real, this is what we're doing about it. We think we've captured about 80% of it. You need evidence, you can't obviously make it up. So there's about 20% to go where we haven't got enough evidence yet. And by the way, obviously, if you combine the first quarter and the fourth quarter together, you can look through it, and you're probably going to end up with if you average those two out, you've probably got a reasonable number. So I thought, from a point of view of national statistics, that's really very helpful in what you sort of look for, really, to say, yeah, look, things happen in national statistics. I mean, the world is messy and noisy, as it were, and I thought that was a very good example of the ONS dealing with it, and we work very closely with them. So I think we're getting back to that place, but we will continue to work very closely with them because it's very important.
But a recent example, of course, has been the flash forecast for April of 100,000 reduction in payroll numbers.
Yes.
Normally would have assumed to be flowing through into increased unemployment figures. But if the ONS have got that wrong, then policymakers should not assume that would be the conclusion.
We put very little weight on the flash numbers, and the ONS also, if I remember rightly, put a health warning on those numbers.
They do, and they've got it wrong the last 2 years.
Well, they get revised a lot. So, I mean, you can. I think you can have quite a sort of theoretical argument, or even a sort of philosophical argument about, really, if those numbers are so unreliable, should you publish them?
Yes.
I mean, it's the same with monthly GDP. There was a great rash of, we really do need to have monthly GDP, and I think people are now beginning to say, well, but it isn't that reliable. So what's the better argument? So we actually put very little weight on the flash number because it does get revised a lot.
Yeah. Thank you.
Thank you. Lord Reid.
Thank you, Chair, and thank you for being with us.
Sure.
Can I raise a couple of issues which are current but also continually controversial? The first of those is immigration. Now, we've seen recently a fall, fairly dramatic fall, on net immigration.
Yes.
What is your view on the impact of a fall of this magnitude, whatever the political discussion is saying, on the economy?
Well, first of all, let me say, as I hope you understand, I do not get involved in discussions about the pros and cons of immigration, because that's not for the Bank of England. But I'll answer your question from an economic point of view, because it's an important question. I mean, it obviously is because it's an important part of the labour supply question. So it is relevant. What I would encourage is putting it into the sort of broader perspective of labour supply, because there are several very big moving parts in this story, of which this is one of them, and it is an important one. The others, I think, are the fact that we've got an ageing population on average, and will continue to do. I mean, this is set in the future because it's due to a falling birth rate. The third one is the one that was obviously very much in the news last week, which is the question of young people's participation in the labour force. The fourth one is one that actually probably was in the news some years ago, but doesn't get much coverage now, but actually has offset some of the negative numbers on participation, which is that we've been going through this period of increasing female participation because of the equalisation of the retirement ages. But you can only do that once, obviously. That's coming to the conclusion. And the fifth one is obviously looking forwards, which is what is going to be the effect of AI, artificial intelligence, on employment. And I would say that because I would encourage, I do think it's important to sort of tell the economic side of the story around each of these, including immigration, actually. And it's important to put them all into context together to see the overall picture, which I don't think often gets done. You don't mind me saying so.
Thank you for tiptoeing through a minefield.
Yes. If I'm still alive, I don't know.
Let me throw another couple of hand grenades then.
Thank you.
I mean, basically, what you're saying is all very complicated, which I think we all understand. And you identified 5 dimensions. Taking them in aggregate, does that mean that the labour market is still a source of serious uncertainty, given the unpredictability of some of these things, in terms of policy formulation? Or is it no more difficult than it's ever been?
Well, I think looking forwards, it is an important issue because, going back to what I said, I think to the first question, the chair's question, this lower growth story over the last 15 years actually hasn't so much been a story about labour supply. And part of that story, of course, was that prior to this latest immigration number, immigration was higher than it had been presumed it would be. Let me put it that way. Going forwards, and going back to this question about how we get growth and potential, the growth of the potential capacity of the economy, maintaining labour supply is obviously an important part of that story. And you have to set that against, as I say, the context of an ageing population particularly. Now, I'm not going to say, therefore, the answer must be, immigration must be higher, because that's not my territory, frankly, and it would be wrong for me to go into that territory. But what I do think is that this whole debate needs to be set in the context of, we need to maintain the labour supply in the economy. What is the way to do that? I mean, what is the most effective and best way to do that? Taking all these things into account, of which immigration is one of them.
Okay, and you mentioned wrong assumptions about the level of immigration.
Yes.
Are there lessons that we can learn from previous periods where that's been the case as well? I mean, I recall 25 years ago it was predicted by our learned academics that the number of Polish immigrants, if we opened up, would be 18,000. I think that was about 850,000 short of that figure.
Yes,
there must be lessons from that.
Yes, I'm sure there are. And, well, I mean, it is the case that certainly if you go back to the few years ago, only a small number of years ago, certainly we had to revise our forecasts very substantially because, in fact, the immigration numbers turned out to be very different to the ones that were in the. We don't do our own immigration projection, and we use largely the ones the ONS and the OBR come up with actually, and so of course it turned out the actuals were very different to the forecasts.
Okay, and final question, Chairman, if I might. You referred among the 5 factors that you outlined. I hate the acronym NEAT, but we're left with it. The young people who are not in employment and so on. Would you like to say something on the long-term economic impact of that?
Well, I think it's not our area, but I think we have to take it into consideration. I think it is very substantial. And I think particularly when you set this into the context of an ageing population. I mean, if you combine an ageing population and lower levels of of participation in the labour force by young people, then you become more worried at that point. So I think
and a lower birth rate.
And yes. Well, the ageing population is reflecting a lower birth rate. I mean, there's some obviously an increase in longevity as well, but it is principally reflecting a lower birth rate, as you say rightly. And if you combine those two things together, I think that's a very, very important issue and a very serious issue. Yeah.
Okay, thank you, Chair.
Can I ask one quick follow-up? You said very interesting remarks at the beginning about the UK productivity problem in the last 15 years.
Yes.
And of course, it's not as simple as just rectifying what the relative problems were in order to boost productivity in the future, as you also said. But what's the best account, in your view, of the major drivers of that disappointing productivity growth in the last 15 years?
I think it is principally probably a technology story. So, I mean, I think there are long cycles of technology in that sense, because there are these things called general purpose technologies. And the whole point about a general purpose technology is that it spawns innovation across the whole economy. So it's not limited in that sense. So the internet ICT is a good example. As I say, the original case is the steam engine, I think. But there are pauses in those periods. I mean, we had one in the late 19th century as well, actually. So there are pauses, and I think it is quite possible that we have pauses. Because I have to say to people say to me, yeah, but the internet's everywhere, surely. Here we're talking about the contribution to growth. So eventually, you do sort of saturate the economy with an innovation, and I think that probably did take place, broadly with the internet, for instance, and ICT. And the question then becomes, what's the next one? So I think that is a part of the story. It's not anybody failed. It's the next big question is, how quickly are we going to see a leg up in productivity from further innovation?
A little bit on this question.
I was going to ask a follow-up question on this, going back to inflation. Yeah. So in a way, all these indicators, except potentially AI, point to a reduction in labour supply and ultimately a reduction in output.
Yes.
Is this fundamentally inflationary? Is it something that actually is going to, beyond, you talk about long-term, short-term, there's all moves in the short-term, but long-term, and we have a strike now, people want to only work 4 days a week rather than 5, and you would say most people, to some degree, in the economy, tend to maybe not work for
well, if it restricts the supply capacity of the economy, then yes, it does have an effect, and we have to take that into consideration in setting policy.
Thank you. Lord Newby.
Can we move on to reserves and
yes.
two particular questions? The first is the fact that the bank pays interest on commercial banks' reserves with you, which is a very considerable sum. And some people think that it will be a good thing if you didn't. Because the banks it could be required to have a certain level of reserves anyway, and the interest is money that, in the nicest possible way, they don't need in an economic sense. That may or may not be, probably is questionable actually, but you can question it. And the second thing is, which we had a lot of debate about in the aftermath of the financial crisis, was what is the appropriate level of reserves?
Yes.
We went round the houses as to how you decided that. We have decided something. Do you think in current circumstances that level should be revisited, or do you think it's doing what it's supposed to do?
Yeah, no, thank you. That's very, very good questions, actually. So let me have a go. I'll take them in turn. So paying interest on reserves. So it's not free money, as it sometimes gets portrayed. Let me do a bit of the accounting, if you don't mind, to start with. So when banks hold reserves with us, which is what these are, those reserves are an asset on their balance sheet. They have to fund that asset, so they have to pay the cost of funds to raise those reserves. So you've got interest rate on either side of that. It's not this is not free money in that sense. And I'll come back to the question of what they earn in a moment. And when you look at our balance sheet, it's a liability on our balance sheet, which we then invest. And we are moving over time to what we call a repo-funded balance sheet, which means there will be no interest rate risk. No interest rate risk on our balance sheet. I mean, I know that's the second slightly different question, but equally gets in the news. So again, the aim is that this is a sort of a balanced system, and it's an equilibrium in that sense. And if you disturb it by saying don't pay interest on reserves, then you're going to disturb the system. Now, let's come to that. On the question of do banks need the earnings, well, I would argue actually they do, because they have to earn their cost of capital, at least. And this is reflected in their market valuations. So we went through a period of about 15 years post the financial crisis where they were not earning their cost of capital, and their so-called price to book, in other words, their market value versus their book value, the market value was below the book value. That is now not the case. That hasn't been the case the last year or two. But that is important. I mean, banks do have to earn their cost of capital in that sense, because that is the basis on which the shareholders are prepared to provide the funding. I do recognise, by the way, that one of the challenges, I think, in that is that it's easy for me to say in a slightly sort of clinical way, earn the cost of capital. Because of the size of banks and the size of their capital, that is a lot of money in terms of when you look at the pounds and pence earnings of banks. To earn your cost of capital, you do have to earn a lot of money. I recognise that, but that is the, the economics of it. So if you said don't pay interest on reserves and require them to maintain the current level of reserves, that would knock a big hole in that, in their earnings and their earning of cost of capital, because an important part of their earnings is what's called the net interest margin, which is the balance between what they earn on their assets and what they pay on their deposits. And they would have to pass that. Well, they would have to do one of two things. They would either seek to shrink the level of reserves, and that will bring us on to the second part of the question, or they will pass it on to customers. So in other words, mortgages will cost more and payment on deposits will be less. So let's come on to the second part of the question, the level of reserves. We don't target a level of reserves. Some central banks do, actually. We don't. Our system at the moment is that we will meet the system's demand for reserves. Now, the stock of reserves at the moment is actually higher than the sort of steady state demand because of the fact that we've done quantitative easing in the past, and it's coming down. So it's currently, I think, about £640 billion. At peak, it was about 980. So the next question is, where's the equilibrium? We don't know exactly, and it won't be constant over time, by the way. It's below where we are today, but I wouldn't be surprised if we've got 100 or 200 to go to hit that equilibrium. Now, the question then is that too high, too low? It's what they think they need. And let me say two things on that. First of all, reserves are the highest quality form of liquidity in the system because it's cash at the Bank of England. You can use those immediately. So if you have if your deposit has started to run, then that's immediate. You don't have to do anything for that money to be available. You can pay out. So it's important. And it also smooths the operation of the payment system. The broader point, and this is, I think, very interesting. This is, to me, very interesting. It goes partly back to Baroness Wheatcroft's question, is that liquidity in the banking system also supports the rest of the whole of the financial system. So I made this point to Baroness Wheatcroft's question about the interlinkages between private credit and the banking system. The banking system is still the ultimate source of liquidity for all of this activity. And it is also supporting a much bigger government bond market and the liquidity needs of that, and the fact that we've got a transformed government bond market, as have quite a few other countries, with a much bigger leveraged hedge fund position in it, the liquidity for which ultimately is coming from the banking system, and ultimately, if you like, from us, through the reserve operation. So the fact that the demand for reserves is now higher than it would have been 20 years ago doesn't surprise me. I think if you say, well, yeah, but don't you really want it to be lower, you get into some very deep questions about the whole financial system at that point and what financial system we want, because those reserves are, as I say, the ultimate high-quality liquidity in the system.
Just ask you about the definition of equilibrium. You say the equilibrium would be lower probably in the longer term than it is now. I can see one, I'm not quite sure what the equilibrium's between. You know, what's it a balance between? I can see that the banks have a view about how much reserve they would wish to maintain, but that isn't an equilibrium. That's just a.
Well, it is, because it's how much do they think they need to run their operations smoothly and to meet the sort of the running demand for liquidity, both in normal times and in stress times. So that's that's the way the equilibrium emerges. Now, if you reduced the rate we pay on reserves, other things equal, I think that would reduce the level of reserves they hold. And the question is that there would become a level where we would be concerned that the level was too low to support the financial system without sort of creating the risk of stress.
And you have a view on that? About whether, I mean, do you at the moment think this is, well, presumably you do, or else you do something about it, but the current level of reserves is adequate to meet the likely events where the banks are going
to... Currently, as I said, it's more than adequate because we've still got legacy quantitative easing in there. So we're on a sort of glide path to a sort of to the equilibrium. And as I said, I can't tell you with any precision what the equilibrium is. It will emerge when we get to that point, and we may get there in a year or two. We'll see. So I can't tell you at the moment what that equilibrium will be. But I say I think the theory is all there to support that we will hit that equilibrium.
Lord Reid had a quick follow-up. I think Baroness Wheatcroft as well. So.
Just so that we have the non-bankers among us have an idea of the answer to Lord Welby's question about equilibrium. We can keep using the one, but
yes.
I mean, is it wrong to characterise it as the balance? The equilibrium is the satisfactory balance of resources versus risk.
Yeah, you can look at it like that, yes. Yes. I mean, by the way, I should have said, of course, it also performs another function, which is it sets the price of money, which is the interest rate, which implements monetary policy. That's the first or second part of this. But yes, I think that's a good way of characterising it. Yes.
We like it simple.
When you're talking about the safety of the banks, how nervous do you get when Rachel Reeves starts talking about deregulation and that being the key to growth?
Well, what I say to that is financial stability is important. We won't get growth if we don't have financial stability. Does that mean every one of our regulations is perfectly formed? No, of course it doesn't. I mean, they're not, and they never will be, by the way. I mean, that would be a very strange thing for anybody to say, and shouldn't be believed. So I'm very supportive of looking at the regulations, but I do feel I have to keep saying, look, financial stability is critical to the performance of the economy, to growth in the economy. So there will be points in time, I think, where I have to say, hang on, that's not where I would go to. But there are also other times where I say, no, look, we should certainly overhaul this or that.
Thank you. Swinging back to AI, I think, now, with Baroness Penn.
Yes, there's been a thread through this evidence session of the impact of general purpose technologies and specifically AI and robotics. What work is the bank doing explicitly on the significance of AI and robotics, and what are you looking out for currently and in the future in terms of its impact? I think you said we can see impact in the equity markets. Yep. We don't yet see it in productivity, but because there's a lag. I don't know whether you think we can see it in the labour market, but what explicit work are you doing around this, and then what signs do you see of its impact?
So let me divide it into sort of two parts. That's a really good question. So we are doing a lot of, first of all, obviously like all organisations, we're trying to work out how to use it ourselves as well, and we are using it, increasingly so. In the economy, you're right. We do this through our agents, we do it through surveys, through talking to firms. I go around a lot talking to firms about this. How are you using it? How do you envisage using it? Are you seeing it come through particularly in the labour market, in terms of, we are in a world at the moment where hiring is very low. So we're not in a world of I'm talking about the labour market softening. It's not so much a firing world, it's a very low hiring world. And by the way, that's part of the youth unemployment story. It's not all sort of people sitting at home because they want to. There's a lot of people who can't get jobs who want to get jobs. And are we seeing an AI effect there? Because I think AI is, it's a technology that is going to affect early career jobs. If you think of lawyers, accountants, for instance, that sort of professional services type world it affects. But not just that. I think the message we get at the moment is, I think firms say, we're beginning to beginning to use it. They're not so sure whether it's really affecting sort of hiring discernibly, but I think they expect that it will at the moment. So in terms of the economics of it, yes, we're very actively looking at it. And by the way, in terms of employment, I tend to use, I gave a speech in Sheffield last week on this actually, I tend to look at a sort of 4-part framework with AI, which is it, to what extent is it destroying jobs? To what extent is it creating jobs? To what extent is it causing productivity increases which increase the demand for existing jobs? So, example people might give up on that one is, if AI enables you to process medical scanning much more quickly, you need more doctors to deal with the consequences of it. And then the fourth one is actually sort of slightly the opposite of that one, which is where we're getting productivity increases, but it doesn't increase the demand for labour. So, running data centres, for instance, would be a case in point. It's very, very low employment activity. So that's the sort of the economics of it. The second big thing, which is the big thing at the moment, is the cyber, the thing that really kicked off about 6 weeks ago with the Anthropic announcement, but has now been matched by sort of OpenAI and will be by others. And this is a big thing. This is a very big thing, because we have suddenly seen what I think the experts would call a sort of an exponential, we're into the exponential part of the development curve. In other words, it's been going along and the curve has turned up in terms of what these models can do. And so people who know a lot more about this than I do say that we are now on an exponential curve. So this is not over by any means. And the power of what these models can do in terms of finding, for instance, existing flaws in IT systems is
0 day.
Sorry?
Sorry, I was saying 0 day.
Yeah. Well, yes. That was from the, if you've seen the film, yes. Yeah. Its ability to find flaws in things we've been using for years has accelerated very rapidly, so that we're all facing a very large amount of patching at the moment, and then adapting to a world where this is the norm. That's a big thing.
And just to maybe follow up on each of those parts, and I read your speech where you asked, can AI make cutlery? And I think the answer was not yet, it can help you,
yes,
but it can't make it yet. Do you have a view on those 4 kind of potential paths? And they're not mutually exclusive, they may emerge in different sectors of kind of destroying jobs, creating jobs, productivity increases that increase demand, and those don't. From what we know about AI and robotics at the moment, and recognising its early stages, do you have a view? I think the chair of the Federal Reserve has a kind of particular view of its impact on demand and growth. I don't know whether
Well, I did a bit in that speech, but we could do more, is to look back again at history and say that actually the pattern from previous general purpose technologies doesn't give you a single story. If you look at those boxes, and particularly if you look at the first two boxes, which one dominates, it doesn't give you a sort of a clear answer to that question, but it does set out the sort of framework to I think, to use to think about it and come up with the answer to it. So I don't think we have a definitive answer to that question. The second thing I would say, and I did make this point, I think, at the end of the speech, is, and this is highly relevant, we also have choices. This is not cast in stone. And there are particularly choices, I think, in the whole area of education and skills. Because, I think we shouldn't regard ourselves as sort of as passive victims. I think we do have choices here in terms of how AI is used and how we adapt to AI. And ultimately, I mean, I'm not an expert in this field. I do think it's still people working with AI.
Mm. And on the cybersecurity, coming back to financial stability question, what work is being done in the UK, but also in coordination internationally, thinking about this question?
Well, first of all, I mean, I think the UK has got world-leading AI security institute, and we should recognise that is a world-leading organisation set up, I think, after you're probably involved in it, with the Bletchley Park.
Thank you very much. Yes.
They've done the assessment of these models, and we benefit from that. We work very closely with particularly the banks and insurers that we supervise, and particularly the banks on this, because they're most exposed because of sort of payment systems and so on. We're working very actively with them. We have the CEOs, we talk to the CEOs regularly, and I mean, there's been some reporting of this. We've been working to enable them to get access. International coordination is fast moving. Indeed, since I left the Bank of England to come here, I see Anthropic have made there's been another announcement, and Anthropic is opening up, I think, more. By the way, I'm not criticising Anthropic for that. I think they actually want to be very open. I think it's got somewhat tangled in US developments. I mean, the thing that I would say is that it is critical that this is done internationally. I can put my other hat of chair of the Financial Stability Board on for a moment, because there are very big spillovers. I mean, no country can believe that it could solve this problem within its borders and cut itself off from the rest of the world. It's absolutely critical that this is done internationally, and of course it does have to be done at pace. So this is a very big issue.
Thank you very much. Lord Carrington.
Yes, thank you very much. Coming on to government debt and public sector net debt, historically very high levels for peacetime. Interest rates are pretty high as well on a historic basis. Is there a limit to how much a government can actually borrow? And how would you arrive at what that limit is?
Well, I think the sort of theory would say there isn't, but practically there is. And I think what drives it is that obviously the larger the debt, the outstanding debt, not only the larger the cost of debt servicing, the interest cost in other words, but the more vulnerable it becomes to shocks, particularly obviously, for instance, to interest rate shocks. And of course, you can argue that's some of what we have been seeing in recent years, that as the cost of servicing the debt goes up, at high levels of debt, that becomes much more of an issue for fiscal policy. Because in any system where there's a fiscal rule involved, that will constrain the operation of the fiscal rule. And I think that's what we're seeing. So I would say, in practice, the answer is yes, there is. I don't think it's quite easy to write down a number, but I think the framework tells you that there is such a limit, yes, and it is important. And I think that's why it is important to stabilise that position.
But stabilising isn't enough, is it? Because what you've got to do, I mean, you say you can't put a number on it, which is perfectly understandable. Of course you can't put a number on it, but you can put a range of percentage of GDP perhaps on it. You can say you don't really want to go above
a range of sort of 30 to 60% of GDP, or you are perfectly happy to have that range at 70 to 120% of GDP?
I suppose the reason I said stabilise is that I think in today's situation, I think the first step is to stabilise. And by the way, I mean, look, the budget that we had in last autumn, if it were followed through as put, would do that actually. And I think that's basically why the gilt market was one of the reasons the gilt market reacted as it did, positively. Then I think you get back to the point that I was mentioning at the beginning, which is the growth question, because it is, as I said, we did this sort of naive simulation and said, let's imagine that we'd had the higher growth level and the same fiscal policy. Where would we be today? And the answer is we would be in a different place today. I mean, we wouldn't be back to where we were in some of the low periods because we've had shocks, we've had COVID, we've had Ukraine and so on. But my conclusion from looking at that analysis was that we would be having a very different debate. And that's another way of saying, I think, once the thing is stabilised, then I think the debate about growth is critical, because that's what can help with you're right where you want to go to. That's the better way to get there.
Right. If you're going to go for growth, though, you presume there's a relationship between growth and taxation rates, or the tax take at any rate, in the various sectors. But if your tax take is being taken to fund very large and potentially increasing and disproportionately on international level interest rates payments, that presumably is going to be a brake on growth.
Yes, well, that's what I agree with you, and that's in a sense one of the that's why first of all stabilising is critical, but then walking the channel through to achieve both of those objectives, to get the growth and reduce the interest burden is important. Now, I think it comes back to the debate about technology, for instance, because that's a sort of an external driver of growth. It's not, well, there obviously are questions about investment and so on, but in a sense, the actual origin of the technology will not be dependent on this so much. So these things are really important.
Yeah. I'm just a bit concerned about your word stabilisation, which suggests that where we are is where we want to be, or where we can tolerate being, which is perhaps a better way of putting it, in the sense that we're at a level which we can adapt our monetary and fiscal policy to cope with, whereas actually there's got to be a level which is above that, and stabilising at a level above where you can manage monetary and fiscal policy to cope with it is going to be bad for the rest of the economy, is really what I'm trying to get at.
Fair point. I was actually using stabilisation in a sense of, can we stop going up, please? And then consider how best we get down.
Absolutely, but not as a steady state.
Yeah.
Okay.
I think some colleagues may have some final follow-up questions. I've got one myself, but sorry, Lord Liddell first, and then Lord Burns.
Can I return to the question of financial stability?
Yes.
I worry about financial stability. I don't think I understand it very well, because that's not my field, but I worry that unwise deregulation might result in another 2008, and I wonder whether we could actually afford the massive kind of bailouts that occurred then, in terms of our the debt to GDP position, which Lord Carrington was just talking about. I worry about the asset price boom that Baroness Wheatcroft was talking about, and is that going to result in if there was a stock market shock, would that create conditions in which there might be financial crisis? I also worried, but I don't think this is going to happen, by the way, that if we had a government that thought that it could just spend its way to economic growth, I don't think that is going to happen, that we would also end up in a financial crisis like Liz Truss did. So what's your do you think I'm irrational?
No, yes, Russell. Well, look, first of all, it's an important question because we've gone through a whole series of economic shocks, and we're going through one at the moment. And we've got a resilient financial system at the moment. We haven't had a financial stability crisis. And let's face it, in the past, as you say, we have. And the situation we're in at the moment would be a whole lot worse if we didn't have financial stability. A whole lot worse. Now, one of the ironies I find I have to live with is that, of course, the fact that we're in that situation immediately seems to cause some people to conclude that we're over-regulating. And we have to respond to that, because one of the challenges of financial stability is that successive financial stability is when nothing bad happens. So when nothing happens in that sense, we feel, thank goodness, we survived that one. But it does engender other responses. But I think part of the answer to this is that we have to keep making the case. Sorry, I don't keep referring to other speeches I made. I made a speech in New York at Columbia University back about 6 weeks ago. So I made a point, actually, that financial stability is a lot less well understood in this sense than monetary policy. And the meaning of independence is a lot less well understood. And it is a challenge. And I made the speech deliberately because it's actually a challenge that doesn't get talked about a lot. We talk about it privately. It doesn't get said a lot in public, actually, because it is a challenge. And as I said to the earlier question, it's not because I believe everything is perfect in the world of regulation. That's not the case. But this fundamental point about the need for financial stability is critical. So part of the thing we have to do is we have to keep on articulating the case for financial stability.
Lord Burns.
Thank you. Another cheeky question, Governor. Last time we had a very large government borrowing when facing a crisis. The Bank of England came to the government's help by QE in quite large doses. Could we see that again if it was felt that we need another large fiscal support package if the current crisis?
I do recoil at the idea that we sort of jumped in and supported fiscal policy.
You did say it was a cheeky question.
Yes, nice try. No, I mean, look, if we had to step in, it would be either for financial stability or monetary policy reasons, or both. And as I said, going back to the previous question, to Little's question, we're not facing that situation today, so there is no case for us doing that. Moreover, I'd go further than that and say, for me, if you go back to the LDI problem in 2022, and I'm not popular in all quarters for the fact that we stopped our support, but that was critical for me for the independence of the institution, because there was a very precise financial stability problem, which was in the LDI pension sector. We knew what it took to solve it. We knew once it blew up, we had a pretty good idea what it took to solve it. And for me, it was critical that we didn't go beyond that. So that's not made me, a great popular figure in some quarters, but that to me is critical to this, that our operations are strictly limited to our objectives, both of them.
You raised this issue about, in a sense, relaxing the degree of regulation a number of times. I am on the record of having myself argued that I thought immediately after the financial crisis the regulation was too tight. And this went on for a number of years, and bank lending fell very sharply to some quite critical areas. On the other hand, we've now seen quite a degree of relaxation of that regime. And as you said earlier, looking at the bank's balance sheets and the cost of capital, etc., that things are now back to a more, in a sense, sustainable position. At some point, though, it's going to be necessary, is it not, to say to people, so far, no further. There comes a point where, just as you can over-tighten at the wrong moment, or well, at particular moments, so this can go too far when one tries to respond to that. And I just get slightly nervous that somehow this is beginning to become a one-way. It's
a very good point.
Chatter.
It's a very good point, because you're right. I mean, I do think we've got a stable banking system in the best sense of the word. I mean, they're more than earning their cost of capital, which they should, and they can compete. I mean, just to illustrate it with one point, I do recoil when I read comments from banks that we can't afford to lend to people. Because I said that just can't be true economically, because you're earning more than your cost of capital. So if you make that point, you're telling me that your shareholders do not want you to use the earnings that go above your capital requirements to support the lending, even though you're earning more than your cost of capital. Is that what you're telling us? Actually, it isn't, actually. I mean, I don't think. So I do recall that. It's a way of illustrating a point. I mean, it is a very important point. And of course, it's a contested one, and I understand that. But it is a critical point.
Lord Reid had a quick question.
Yes, it's just in this question of regulation, which I take it to mean up until now that you've been referring to banking and regulation. Do you take a view on wider regulation on industry and commerce? I mean, if I recall, you said that if there was something in the banking side, presumably, that you thought was deleterious to the economy, that you would make your views known, whether privately or publicly. What about the quantity of regulation on industry and commerce in general? If that reached a level where you felt that it was not only nugatory, but a hindrance to economic growth, you would make your views known in a similar fashion?
Well, obviously, look, we're responsible for regulating specifically banks and insurers, but also the financial system in terms of our overall financial stability. But you're right. I go around the country a lot talking to businesses, so I pick up a lot of stories. They're not in our direct responsibility. I do pass things back. I mean, I do think that we need to take this very seriously because I think it has taken longer to do things nowadays. I'll give you an example. I don't think it's not a particularly specific story, but it's a good story. I went to Orkney a couple of years ago on an industrial visit, and I went to the oil terminal in Flotter, and it's still operating. It's not as big as it was, but it's still operating. And they showed me, I went around it, and there's a plaque on the wall. And they said that they built that terminal like early 70s, I think, from start to finish. I'm trying to remember exactly. It was somewhere between 18 months and 2 years. And they said you couldn't do that now.
Yeah.
So I do think there are questions that we answered, and I do hear those stories quite a bit. Yes.
Ernest Wheatcroft.
Very quickly, if I may. Do you think that there are issues in the economy that the country as a whole has been ducking for quite a while? And I think, for instance, particularly given the demographics that we've talked about this afternoon, unfunded pensions, public sector pensions, that is, the student loan book, most of which is still treated as an asset, I think. Do these cause you any concern?
Well, I mean, I do think that, I mean, it's easy for me to say this, I know, but I do think, let's go back to the sort of the big challenges, particularly in the fiscal area. So let's take two of them. We could take a third one as well. I think explaining the consequences of an aging population, one. I think explaining the consequences of what appears to be the end of the post-Cold War defence dividend, two. Explaining the consequences of adapting to climate change would be the third one. I mean, I'm getting old, I know, and that's a fact of life, but I do feel that we need to focus on explaining these things. They're not easy to explain. I don't for a moment pretend that they're easy, but they are very important because, I think if we had one of those things at any given moment in time, we would feel we've got a big issue on our hands, and we've actually got a number of them.
Can I just pick up on something that you raised? I've been lobbied, and no doubt others have, on various people on the extent to which the bank is looking at the potential impacts of climate change on long-term economic position and indeed stability if we have a lot of serious unforeseen events. And I just welcome any thoughts that you have or any explanation of any work the bank's doing in that area. I mean, we've talked about an ageing population, which is a big challenge, about AI, which is a big challenge, but
no, we are.
Climate's a big challenge as well.
Be happy to do that. If it would help, I would be happy to also write in, because we had a few MPs in recently who asked us the same question, and we gave them an account of what we're doing. And we are doing, continuing to do quite a bit of work, or quite a lot of work actually, in this area. I do also think it's important to put it into the context of what we're seeing with the consequences of the Gulf crisis, because I'm not an expert in this field, but I do think what that illustrates is that actually the economic case for renewables is actually strengthened by that, because the UK actually does have renewable supply. But I think it is still the case that we are dependent on a marginal sort of source of balancing energy, which at the moment is gas. And that has a lot to do with driving the overall price of energy in this country. And I think resolving the balance of those two things going forward is very important. It's not for us to do, but I think it is. We do look at it a lot because it has an effect, obviously, on energy pricing and on inflation. And I think resolving those two things is important.
Aris Penn had a very quick follow-up on the climate change question.
Well, just to add, it would be really useful in that kind of written response if it also addressed the work the bank's doing explicitly on nature degradation, as well as climate as a potential source of shock. And I think the report on adaptation from the Climate Change Committee this week shows that it's not a question of kind of if certain scenarios will happen. There's an element of knowing that shocks are going to come from our current path, regardless of different choices we make about future
we can
mitigation.
pick that up, yes.
Yeah, fantastic.
One more, and then I'll reserve the right for the final one. Lord Pettigrew.
I just one observation and then one question. The observation is that we've been worried around this table around asset inflation or asset bubble. Am I right in thinking that is an American question and not a UK question? I mean, I read, housing prices going down. Obviously our stock market has gone up, but it's not at the same levels as the US. So do we have really an asset bubble in the UK? Question. And my second question was, level interest rates is obviously, the gilt market is very stretched compared to other countries in Europe. Should we be very worried about the sense of we are in this sort of circle of rates are at 5.5, growth is below 1. We're compounding and inevitably increasing debt. Even if we didn't have deficits, the debt will effectively increase every year by definition. What is the right? Should we really worry about it? I mean, to me, this is ultimately the proof.
Yeah. Okay. So on the first one, well, you're right. I think far more of it is a US issue because they've had more growth, they've had more productivity growth. But actually, that market is so big that we would not be immune from the consequences of it going the wrong way. On the gilt rate point that you're making, I think it goes back to Lord Carrington's question, because I think the question is this. You could imagine in the worst of all worlds, you get this sort of reinforcing circle where, because the cost of debt servicing goes up, that strains the fiscal rule. The consequences of that strain causes more loss in fiscal policy, which puts the cost of debt up, and you're into a sort of bit of a vicious circle at that point. So there's another reason to support the argument that stabilisation is important.
One last question, Governor, and you, again, at the beginning you mentioned the two ways out of the low productivity position that Britain is in. You mentioned technology, which we've discussed quite a lot, but you also said trade, and I just wondered what you could say, if you could say something about your view and the bank's view on the trade scenario of the world at the moment. I mean, are we now, do you think, in a protectionist world, and are we likely to be in that world for a long time? So any hope that trade liberalisation might give boosts to growth and productivity should be dampened, or how would you express it yourself?
Well, I hope not, because I think that's not a world that we should want to be in globally, and I recognise we've got a lot to do to, in a sense, address that question. We are doing a lot of work with others around the world, really to get this question about imbalances properly on the table, external imbalances onto the table, to reinforce the work of the IMF particularly on this, because they're the people who have to sort of speak truth to power, if you like, on that. To keep the WTO going in the sense of, please do not abandon this at the moment. Okay, it's not had a good run, but please don't lose it. And that involves really getting under the lid of what's driving these imbalances. So what's driving the imbalance in China? What's driving the imbalance in the US? What are the causes of these? What are the answers? And I think we have to do that because we have to get to what steady state trade regime do we want to have in the world? And I hope it's not the one that has protectionism in it. And I don't think tariffs are the answer to the underlying issue here, because the underlying issue in many ways, and it goes back to it goes back to some of the discussion about technology and some of the issues we've seen in history, is some of the big impacts, particularly of China's entry into what the world trading system left, scarring effects on communities. And this is what you see. I mean, you don't just see it in the US, but you do see it particularly, obviously, it's become a big political issue in the US. Yes, those questions have to be dealt with, but I don't. Tariffs are not the answer to those questions, and we need to, in a sense, keep working to try to get a world trade system that does survive and does come through with freer trade, because it is very important. I'm going to Kirkcaldy on Friday to talk about 250 years of the Wealth of Nations with Adam Smith, so this is very appropriate at the moment, but it is something we have to preserve and keep going, and it's a lot of work.
I used to work for a chancellor from Kirkcaldy, in fact, so...
he's organising it.
Well, listen, Governor, thank you so much for your time and for covering such a wide range of questions. We're really, really grateful, and with that I can say the meeting is now concluded.